Hello. Good morning, everybody. Just waiting for the deck to be loaded, the keynote. It's up? Okay. Oh, not yet. So, hi, everybody. Good morning. My name is Mauricio de Bartolomeo. I am the co-founder and chief sales officer at Ledin. And today, I want to talk to you about what I like to call the $1 trillion bridge. And it's a presentation about how the ABS market, the asset-backed securities markets, will fuel the Bitcoin credit revolution. So here we go. Which slide are you on? The presentation roadmap or the... Which slide are you on? $1 trillion bridge. Okay, perfect. And now you're on the presentation roadmap. Okay, excellent. So what are we going to go through today? So today we're going to go through four main things. Number one, what is the current state of the Bitcoin-backed loan market, and what are some projections as to where this thing can go? Number two, we're going to analyze the collateralized debt market structure in the US. And the next question we're going to ask is, how are we going to finance the next $1 trillion of Bitcoin-backed loans? Where's that money going to come from? And we're going to wrap it all up by tying together why this is all good for Bitcoin and how this is good for Bitcoin. So let's start. First, a little bit of data on the Bitcoin-backed loan market today. The best estimates we have for the size of the Bitcoin-backed loan market, although not perfect, are the Galaxy quarterly lending market reports that come out at the end of each quarter. And as per the Q4 2025 data, they estimate the CeFi lending market to be $27.56 billion. Now, that number is a big number. However, if you dig deeper into that figure, you see a few things. Number one, 90% or more of that volume is institutional. These are not loans going out to Bitcoiners. These are loans mostly going out to miners, hedge funds, family offices, treasury companies, etc. There's also potential double counting in this data because groups like Tether, who are an investor in Ledin, lend to groups like Ledin, and then we lend. And so both Ledin data and Tether data are in here. So a lot of that has to be cleaned up and eliminating the double counting. And the third piece of this is that in this CeFi pile that you see here, there's a lot of non-Bitcoin collateral. So we have to back that out as well. And when we run our analysis at Ledin, we estimate that the end user Bitcoin-backed loan market today is roughly $3 billion. It is growing exponentially, as you can see from the chart in the Galaxy data, and as we can see from our numbers. We estimate that we have a 30% market share of this, of all Bitcoin-backed loans today, meaning that 1 in every 3 Bitcoin-backed loans done worldwide are done at Ledin, which gives us a pretty good vantage point about the around the industry and trends and basically how people are using these loans. Why are Bitcoin-backed loans so popular? Bitcoin-backed loans are popular, in short, because they work. The people that have used them and used them responsibly over time have done well. And we can show you this. This here is a model. It was current as of the end of this year. It has to be end of last year. It has to be updated a bit. But this is an example of a person that took a $100,000 Bitcoin-backed loan on January 1st, 2020, and managed that loan responsibly until today. Bitcoin-backed loans can be rolled over and the term can be extended. We have Ledin clients that have had loans for 5 and 6 years. So this is a client that took out a loan on Jan 1st, 2020, and managed it responsibly until today. This loan at the beginning needed 27.3 Bitcoin. The Bitcoin price at the time he took the loan was 7,318. He had to top up when the COVID crash happened. He had to send an additional 13.5 Bitcoin. From that point on, he was able to redeem Bitcoin as the price improved. At Ledin, you can redeem excess collateral from your loans. So this person put in 27.3 and an additional 13.5 and was able to redeem 22.25 throughout the course of the loan. That loan today would be $225,000. That person's net worth today would be 1.8 roughly million dollars. If that person on January 1st, 2020 had instead sold half of their Bitcoin, instead of taking a loan, their net worth would be $1 million. So by taking out a Bitcoin-backed loan and doing it responsibly, that person has a net worth of 1.7 million as opposed to 1 million. He is 78% better off financially by having done so. This is why people keep coming back to the product. How are people using Bitcoin-backed loans? This is the data that we show at Ledin. And again, I like having a breakdown of, broadly speaking, these buckets. There's a lot of nuance in these buckets, but broadly speaking, The largest shares are buying traditional investments, and these include property. Property is a very, very big use case for Bitcoiners buying or using Bitcoin-backed loans to diversify their Bitcoin portfolio into a hard asset like a home. They're also doing it to buy more digital assets. A lot of people borrow from the Bitcoin to buy more Bitcoin, buy Bitcoin treasury company equity, etc. 25% of people use it to pay for expenses, and 20% of people roughly use it to pay down debt. Now, beyond the Bitcoin-backed loan markets, what does the collateralized debt market, broadly speaking, in America look like today? It is a $9 to $12 trillion market, and this includes government debt and instruments collateralized by corporate bonds. However, there's a very important piece about the collateralized debt market today, and that is that the underwriting model is based on your income. It's based on your debt servicing capacity. I can't state this loudly enough. A mortgage is not a loan on your house. A mortgage is a loan on your income that is also backed by your house and also backed by all your personal assets, okay? There are many issues with this underwriting model. This underwriting model, I'm going to make the argument to you that this underwriting model is broken. If you don't have steady and fully taxable employment income, you do not qualify for a loan. Every entrepreneur, every contractor, every self-employed person that's in this room knows this all too well. The underwriting model rewards obedience and punishes innovators and free thinkers.
BitBlockBoom started because we were outsiders and we needed a place that felt like home. Stockyards were always a place for people who didn't fit in. Let's go take a look at the cow town. Put on your hat. Let's go. Stockyards weren't just a cattle town. It was a place for cattlemen, traders, outlaws, and gamblers, people that were building something new. And that sounded familiar. Butch Cassidy and the Sundance Kid were known to spend time here, and Bonnie and Clyde stayed right here at the Stockyard Hotel. Hotels were great, but they're too normal, and Bitcoin is anything but normal. So we moved BitBlockBoom to a place with some edge and some history. They still run Longhorn Steer down this street every day, just like they did 100 years ago. And BitBlockBoom, well, it's just a few steps away. This is Mule Alley. This is where relationships are made. Bars, restaurants, rodeos, hangouts. Mule Alley is the place to come when the BitBlockBoom day is done. BitBlockBoom was built for people who didn't have a home, and the same thing applies to the stockyards. Seems like we finally found a home. See you at the stockyards.
The current income-based underwriting model is dying, and I'll present the arguments as to why. Over the last 25 years, the rate of homes in the US with a mortgage has dropped from 47% to 39%. Based on estimates, denial rates for small business loans have gone from 30 to 50% to 50 to 80%, especially at large banks. And the criminal part is that these loans are partially guaranteed by the US government, in many cases fully guaranteed by the US government, but they're not helping the borrower. They're protecting the lender, guys. They're protecting the lender, okay? Why is this model incompatible with our future? This model is incompatible with our future for many reasons, but the main ones are these steady income opportunities that are needed to get these bank loans are going away by the day. Only 60% of eligible Americans have a full-time job today. That's down from 64% in the year 2000. And population has grown quite a bit. The few high-quality executive opportunities that remain in the West are overtaxed. People in the West are overtaxed. There is no more room to go. The collateralized lending market that leads the next revolution has to be digital and has to be globally accessible. It is necessary for it to run at the speed of commerce. We need to simplify the eligibility criteria. We need to allow for equitable access and terms for people around the world. We need to limit personal liability as best we can, especially for business loans, to foster innovation. Fortunately, we have a model today that allows for that, and that is Bitcoin-backed loans. And this is why I make the case to you that Bitcoin is and will continue growing as the king of collateral. What makes Bitcoin collateral revolutionary? It has clear benefits for the borrower, and it has clear benefits for the lender. What are the benefits for the borrower? If you're using the same collateral as everyone else, it means you should be able to get the same terms as everyone else. And you do. And that is financial inclusion. Being able to access world-class financial institutions with 2 clicks, you can send your Bitcoin anywhere and access the best financial entities in the world. Few clicks, no plane flight, like no travels needed. And that helps you manage your risk if you're living in a hostile country, like I did in Venezuela. A Bitcoin-backed loan prevents you from selling your Bitcoin, which is a great tax benefit in most countries. Borrowing against your Bitcoin is not a taxable event, whereas selling your Bitcoin is a taxable event. So it's actually way more tax efficient. And last but not least, a Bitcoin-backed loan helps you or lets you keep the upside on that Bitcoin collateral. What are the benefits for lenders, groups like Ledin? Well, if I can get collateral from people all over the world and it is the same collateral, that means I can underwrite loans across the world equally, uniformly. That is fantastic because my market is now the globe and I don't have to worry about whether Billy lives in Minnesota or Medellin. The ability to sell that Bitcoin 24 hours a day, 7 days a week on regulated venues with very deep liquidity means I can offload my risk at any time. And that allows me to build world-class risk management systems. I believe that the future will be built by spot Bitcoin-backed loans, accessible 24/7, with equitable underwriting, and the collateral has to remain in custody at all times. What will not build the future are most TradFi or DeFi versions of Bitcoin-backed loans. And I will explain. What are the issues with TradFi Bitcoin-backed loans? People are here probably already know that with the advent of ETFs and IBIT and digital asset treasury companies, all these brokerages are trying to lure you Bitcoiners to convert your Bitcoin into sweet paper Bitcoin so that they can lend you dollars on their margin accounts. However, there are many issues with this model. Number one, Bitcoin equities used as collateral for margin loans are always rehypothecated. Banks cannot help themselves. They are built to lend everything they touch, including collateral. And that is a big problem. The second one is that Bitcoin equities or ETFs do not trade on weekends. So if you are in a position and a strike happens overnight on Friday and you can't get out of that position until Monday, all those savings you got on the interest rate get wiped and you get creamed when market opens on Monday. Because of all of this, the loan-to-value ratios are much lower when you are using these equities as collateral, which means that the broker has 4 times the amount of assets to lend from you than they are lending to you because they're lending your collateral. And the last one, that's the LTVs. And the last one is that there are fees for these things. There are fees to turn your Bitcoin into an ETF. There are fees to bring it back out. There are fees to hold assets at your brokerage. What are the problems with DeFi Bitcoin-backed loans? Decentralized finance protocols are also trying to lure Bitcoiners into their blockchain ecosystem with too good to be true offerings. They are doing this because they want you to wrap your Bitcoin into their protocol. The act of wrapping your Bitcoin not only is a taxable event, but creates centralized custody risks that can enable rehypothecation. Somebody has that Bitcoin and they give you an IOU. When you deposit your wrapped Bitcoin into a DeFi protocol, most protocols give you a deposit token that you can then take and put in another protocol and borrow some more, and then take that token into another protocol and do the same again, which is rehypothecation. again, this is a very, very big risk. The rates on these things are variable and can change suddenly, leading to liquidations, which, by the way, can charge you 4+% in liquidation fees. This is all without even getting into the myriad of risks that are in the smart contracts, the price oracles, and the dependencies, and the hacks. So let's bring it back to the Bitcoin-backed loan market. How big can this thing get? To estimate this, we look at the potential size of the Bitcoin market cap. That's the column on your far left. And on the top of the chart, of the matrix, you have what is the percentage of Bitcoin that is being used as collateral today versus what is the historical average for equities, what is the historical average for vehicles, and what is the historical average for mortgages. And you can see that even if Bitcoin were to take even if the same percentage of Bitcoin were used as collateral as equities are today, this market 10x's. If we go to vehicle rates, this 200x's. And if it goes to mortgage rates, well, I can't even compute that. And now that's at the current Bitcoin market cap. We all know that that's not going to stay there. And this market can very quickly become a $1 trillion market. In fact, it's doing so right under our nose. So to draw an analogy, let's look at how more traditional debt markets are financed. How are mortgages financed? How are auto loans financed? How are credit cards financed? Well, what you have on the screen is the percentage of these types of loans that are securitized and sold into the market. What does that mean? It means that these loans are getting packaged up in a bond and sold to institutional investors to go off the bank's balance sheets. And I will explain how all this works and why it makes sense for the banks. But the key takeaway from this slide is that 70% approximately of all mortgages issued are packaged up and sold as bonds. 25% of all car loans that are issued are packaged up and sold as loans. Even 7% of credit cards are packaged up and sold as bonds. And another thing is, two things that are important from this chart. The bigger the market, the bigger the securitization rate. And the second one is, the better the collateral asset, the higher the securitization rate. Keep that in mind because that one is very important. The quality of the collateral being used for that loan drives how much of that loan people want to securitize as debt. Why do issuers securitize debt? There's three main reasons for this. Number one, scalability. If I have $100 million on my balance sheet and I lend that $100 million, I'm out of money to lend. I cannot scale my book any further. What do? You package up that $100 million into a bond, you sell that bond to institutional investors, and you get a new $100 million to go do it again. One is transparency and resilience. Issuing an asset-backed security is a very long, arduous process. And asset-backed securities offerings are scrutinized by independent rating agencies. This provides assurances to investors, and we'll get into that one in a second because that one is a very, very important point. These structures are typically built so that they are bankruptcy remote from the issuer. Once you put a bond on the market, the issuer of that bond, i.e. Ledin or any issuer, can go under, and the bond investors will still get their return because there are backup services and continuity plans in place for these bonds to exist. That is one of the main why they become so attractive for these institutional investors. There's a structure that's been being used for hundreds of years, I would argue. The third one is cost. The cost of your equity is higher than the cost of the debt. So you're much better off packaging off your loans that you issued from your equity and selling it off into the debt market than carrying those loans with your cost of equity, which tends to be much higher than the cost of anyone's debt. So who buys ABS? Like, who buys these asset-backed securities bonds? The buyers of these bonds are pension funds. They need AAA, the highest credit quality. They cannot take any risk. They just need something that is safe. Same goes for insurance companies. Same goes for banks. Then you start getting a little bit out the yield curve. You get money market funds and corporate treasuries. Then you get go a little further down the yield curve or the risk curve, you get asset managers, mutual funds, and ETFs. And at the far right end of the yield curve or that risk curve, you're going to get the hedge funds and specialist managers. They are in to basically find mispricings and get high yield on what they determine to be low risk. Importantly, when an ABS goes to market, it has to get rated by an agency. And there are many ratings. A rating by an agency is like a report card you get, the grade you get on your report card. In order for pension funds, insurance companies, banks, which are the biggest buyers in this pool, to be able to buy your ABS, you have to get an A, meaning you have to get an investment grade rating. And you have to get it from one of two very reputable ratings agencies. And these ratings agencies are S&P Global and Moody's. How big is the US ABS market? This does not include mortgage-backed securities. This is just consumer ABS. The US ABS market is $1.83 trillion. To give you a sense of the size of this market, in 2025, there was $380 billion in debt issued in this market. 90 to 95% of all that paper was investment grade. Again, the takeaway from this is just an extra slide on the same point, but 90 to 95% of this paper is investment grade. It has to be. The takeaway here is that it's investment grade or else. What does it take to get investment grade? Well, if you look at S&P and Moody's and their requirements, they need you to have data spanning a full business cycle, including stress. In Bitcoin terms, that means you need to have data for 2020, which was COVID, and you need to have data for 2022, which was the Alameda implosions. So whoever wants to get investment grade on this type of ABS today has to meet that. You need to have size. To have a meaningful offering into the ABS market, you need at least $100 to $150 million, meaning that your book size has to be multiples of that in order for you to continue vending in loans to that facility. The third one is your legal structure. You have to have your I's dotted and your T's crossed. Number 4 is credit enhancement. You split the debt into risk tranches so that you can target certain ratings on different risk tranches. They will rule your risk management processes. They will rule your legal agreements. They will basically take everything about your system and stress test it in scenarios that you never thought were possible, to come out with what they estimate is the potential possible loss and recovery from this offering. You need to have business continuity. You need to have a plan for what happens if you get hit by a bus. And you need to have transparent reporting. Every month you have to show data. You have to make sure you continue to do things right. The ratings agency requirement, and in order to be determined and investment grade, the rating has to come from either S&P Global Ratings or Moody's. So how has this market evolved over time? In 1985, we got auto loans. 1987, we got credit cards. Late 1980s, we got collateralized loan obligations and equipment loans. 1995, we got student loans. 2025 was a record year for the ABS industry. It was the largest issuance year ever. This has been around 40 years. And in 2026, we brought the first ever Bitcoin-backed loan ABS market in the United States. Lennon did the first ever investment-rated Bitcoin-backed loan offering. It was a $208 million offering. The rating came from none other than S&P Global. It was the first time S&P has ever rated a big product. It was the first time S&P has ever given a big product an investment grade rating to a first-time issuer. This deal was marketed in February this year when the market was crashing. Several of these investors were asking us how our system will hold up in a down market. And in the presentations, we were able to pop up screens and show them in real time that everything was working perfectly. Bitcoin acted as the king of collateral, as it should. And this deal closed more than 2 times oversubscribed, meaning that institutional demand is there when you are able to structure it right. So how was Ledin able to accomplish this? What makes Ledin special or unique in order to do this? Number one, we have an 8-year track record of perfect operations. We were able to show our operations during COVID. We were able to show our operations during 2022. We have scale. At the time of offering, our book was $1 billion. So we have multiples of the offering in order to continue vending in. In fact, we could do more offerings. We have a clear regulatory posture. We've never had issues with any regulator worldwide. That is an incredible feat for any Bitcoin company that's been operating for 8 years. And we have simplicity. It is the same collateral asset, Bitcoin. It is the same loan agreement for everyone, regardless of where they live. This offering has laid the blueprint for Ledin and other lenders to access the next $1 trillion for Bitcoin-backed loans. And I want to tell you something that is not immediately obvious, but one of the key breakthroughs for this product is that Ledin's loans, Ledin's ABS, is the first time that multi-country borrowers have been included into an asset-backed security sold in the US and received investment-grade rating. What does this mean? A standard US consumer ABS can only have loans that have been issued to US nationals, US residents. In fact, there was a company earlier last year that tried to issue a ABS that had people that lived in America but did not have status, did not have US status. S&P gave them a credit watch negative on September 25 because of this. So traditionally, ABS issuances were really only available for American loans, American entities issuing loans to Americans and then selling that into that market. The Ledin ABS is the first ABS in the world that has taken a Bitcoin-backed loan from Canada and put it into an American ABS product. Therefore, we have now been able to tap into the largest capital market, or one of the largest capital markets in the US, and we can redistribute that capital to Bitcoiners globally, equally and fairly. This is so consequential. The fact that we're able to do this is incredibly revolutionary, and I think this is going to have significant implications for the future of our industry and the future of Bitcoin altogether. And to wrap it up, where am I? Oh. We're good? Well, the last one, I don't know, for whatever reason, I can't move to the last one. But the last one is, how is this good for Bitcoin? Why is this good for Bitcoin? It's good for Bitcoin for many reasons. Number one, we now have third-party validation of Bitcoin-backed loans. S&P Global scrutinized nearly every aspect of Ledin operations for over a year in order to get this rating. They now understand our model. S&P now has a blueprint to rate other Bitcoin-backed loans. This did not exist before this deal. The second one is we now have more transparency. Everybody can see our deal. Everybody can see what's the cost of our capital. Everybody can see what's the LTV. Everybody can see the custodian for that facility is Fidelity, and that Bitcoin sits in custody and does not move. Because you know where the Bitcoin is, because you know the custodian, because you know the cost of our capital, and you know the cost of your loan, you can now piece together how sound our operations are. And that helps everybody make better decisions. And the last one, but certainly not least, is better interest rates. By being able to access more and diversified sources of capital, we can drop our interest rates, and that makes it such that our loans can now start at 9.99%, loans over $1 million. And so I believe that a better Bitcoin-backed loan ecosystem means a healthier Bitcoin ecosystem. And I'm incredibly excited that we've charted the path to get the next $1 trillion for people to hold their Bitcoin. Thank you very much. I don't know if we have time for questions. Is there time for questions? If anybody has questions, yeah, you take them.
One questions going once. Yeah.
Mauricio, this is an amazing step forward that you've made. I'm not certain if the people in the room here understand how you're injecting Bitcoin into the backbone of the financial system. So, for everyone here and for everyone that sees this, my question is, what can those that are fans do to go out there and communicate this new financial product and all these steps forward that you've made, and how Bitcoin can absolutely change the financial landscape?
I thank you, Sharon. I think for me, what I would say is when we started lending Bitcoin, when we started lending against Bitcoin, before we started lending, we went to banks and other people to borrow with our Bitcoin, use our Bitcoin as collateral, and we were told Bitcoin's not an asset. Bitcoin's not an asset. Who would ever use that as collateral? So there's this idea, there's this misconception that Bitcoin is for speculation, that Bitcoin is this. And so what I would argue is if whenever you're having those discussions, many people here actually use our products and have our loans and talk about Bitcoin-backed loans. And somebody might respond and say, oh, that's ridiculous. Why would you use your Bitcoin as collateral? And you can now, I would argue that you can now point out and say, my Bitcoin collateral, actually, if you look at, like, objectively, my Bitcoin collateral is now one of the best instruments on Wall Street, right? Like, this offering just got 3 times oversubscribed. The BlackRock ETF is the largest offering in the history of ETFs. I would just try to respond back with facts, because a lot of these people want facts, and to say, oh, you think Bitcoin is still speculative? Have you seen the latest bond offering, the latest ABS offering? Have you seen the Wave Rose Financial, the other Moody's rated product? Have you seen that Fannie Mae and Freddie Mac are now willing to buy mortgages financed with a down payment with a Bitcoin-backed loan? And it's these signposts that I think are going to move us away from it's a weird, novel thing to, oh yeah, you're using your Bitcoin as collateral. It's just completely normal. Yeah. I think we're good. All right, thanks everybody.